Well, the dollar has taken center stage this week as interest rates continue to rise, putting metals in the backseat. Joining me is Mike McGlone, senior analyst at Bloomberg Intelligence. Mike, welcome back.
Thanks for having me back.
I'm hoping you could shed some light on this gold space. As you know, gold has been range-bound for the past few weeks here, except for a few moments of excitement. What's your forecast here for the next 6 months?
Well, gold's getting very close to the point of maximum pain, and that's what you need for a good foundation.
That's a good summary.
Well, to give you the example, is the last 52 weeks, 12 months, the range for gold is the narrowest in 13 years. For silver, it's the narrowest in 50 years, but it's creeping higher. So it needs something really shift to not go higher, and I think that's what happened. You mentioned the dollar. What's really happening in the dollar this week, it's kind of following yields, but yield's pretty high at 3%, and if you look like managed money positions, speculatives, shorts, and treasury bonds, they're the shortest ever. So 3% is pretty good level for expect yields to peak, the dollar to probably peak, and the trend remains your friend for gold. Inflation, weakening dollar, and picking up volatility.
Okay, so you think the metal should have this breakout moment this year?
Well, at some point it should. That's been the problem. Like when you have the narrowest range in 50 years, it could be another year. I mean, what's another year when you're 50 years for silver? I don't know. That's the time is a problem. I don't know. It's a situation in the market seeking a catalyst. It's going to wait for that catalyst and needs something really bearish to not go up.
Well, everyone was really expecting silver to break out, especially with where the gold-silver ratio is sitting right now.
Yes.
Are you surprised that it hasn't broken out here yet?
I am. Silver's a bit of a, bit perplexing, but it makes sense for silver to underperform if volatility in stock markets is picking up, which is happening. It typically does, but that's changing. I think silver is just too low to more traditional drivers. One of the biggest, highest correlations to silver is industrial metals. Industrial metals look increasingly attractive at these levels.
So let's talk to PGMs now. You like platinum. You said it could revisit 1150. And what's the, your theory behind your bullishness for platinum here?
Well, big difference between could and should. It should revisit higher levels, the question of time. The driver is very positive. Number one, you're never supposed to be bearish platinum when it's below the price of palladium, which it is. It's a more efficient catalyst. It's high. We all know the details about platinum. It takes a while to shift. But the traditional drivers for platinum are industrial metals, the economy, and it's the opposite for palladium. It's a little different. So I think that's kicking in some management, and it follows gold much more closely, and silver.
Well, it's interesting because you and I were both at a conference last week that was almost preparing the industry for the future, and that perhaps one day PGMs won't serve as purpose with the advent of electrical cars, and we won't need platinum and palladium for catalytic converters anymore. So that's why I was a bit surprised that you were still bullish the PGMs here.
Yes, well, PGMs, I look at them together, they look very attractive. It's just palladium has, after it's up to 56% last year, it's not the time to lay into palladium. Platinum looks attractive, but it's much different. It's not just PGMs driving that we know. For platinum, it's a lot more jewelry demand and other things, the efficient catalyst factor. And my rule about commodities, markets will find demand and supply will decrease when prices are this low, and that's what's happening.
Fair enough. Bitcoin. You've said you wouldn't be surprised if it could mean revert back to 900.
More of a should. You look at the history of Bitcoin, we'd be lucky. Bitcoin investors, cryptocurrencies, in the history of cryptocurrency, would be very lucky if it doesn't go back to at least the mean from last year, which is 3,000. It really should go back to the mean for 2016, which is around 500. That's what it did in the last big bull market. It blasted off in 2013, and the low in 2014 was the mean from 2013, 190. It's about time it does that. But for Bitcoin to just drop to the 52-week moving average, which it did, and to just that be the bottom, it makes it just look too easy in a space that's really in the mainstream now. It has futures, and it's mature.
But do you think it would be a sudden drop?
It's supposed to be as painful as possible, kind of like it is for gold right now. It's very painful figuring out what gold's supposed to do. It's supposed to be as painful as possible. Volatility should be high. It should make it difficult for people to get long or short. But bear markets, as we've learned, can take money from everybody.
So then would we see those funds flowing back into the precious metals if that happens to Bitcoin?
It's already been happening to some extent. So at the beginning of the year, at the end of last year, we put out a significant sell signal in cryptos, in Bitcoin, and a buy signal in gold. And I have not any reason to change that yet. And the main reason was the Fed was tightening. It's usually bad for Bitcoin. And the advent of futures. The history of futures is for people to short. In addition, you look at supply and demand. There's just unlimited supply of cryptocurrencies, hard forks, new cryptos coming on, throwing spaghetti at the wall, and it's getting very dicey. Different, regulation, taxes and everything, but gold is a much different story. With inflation increasing and volatility picking up, that's a very favorable environment for gold.
Mike McGlone, Bloomberg Intelligence, thank you so much.
Thanks for having me.
And thank you for watching.